Welcome to our Transfer Pricing After Tax Reform webinar. KBKG was established in 1999. We have offices across the U.S. including Illinois, Pennsylvania, Arizona, Ohio, Georgia, New York, Texas, and Pasadena, California, where we are headquartered. We provide turnkey tax solutions to CPAs and businesses. Our engineers and tax experts have performed thousands of tax projects resulting in hundreds of millions of dollars in benefits for our clients. Our team is a diverse mix of tax specialists, attorneys, and engineers from various disciplines. This combination of talent allows us to be the best at what we do and maximize results for our clients. KBKG is a preferred provider for thousands of CPAs across the country. Now I'm going to introduce our presenter. Alex Martin is a principal and transfer pricing practice leader at KBKG. He has 22 years of full transfer pricing experience working in Washington, D.C., Melbourne, Australia, and Detroit, Michigan, over the course of his career. Alex has assisted companies in many industries addressing transfer pricing issues on a U.S. and global basis. As a transfer pricing economist, Alex worked for a Big Four firm for 12 years as a director, a top middle market focused firm for 6 years as a principal, and 4 years as a president for an independent transfer pricing consultancy. While at a Big Four firm, he received a Chairman's Award and Coach of the Year recognition for building a Detroit transfer pricing practice. Prior to joining KBKG, Alex's transfer pricing team was named one of the world's leading transfer pricing consultancies by International Tax Review for 3 years in a row. In addition to working with many top U.S. and global multinational companies, Alex has extensive experience complementing the services provided by leading accounting firms. His transfer pricing practice was featured in Accounting Today for an innovative approach to partnering with professional service firms. He is well known for building in-house expertise based upon his experience developing a Big Four firm's transfer pricing training program. Alex is best known for developing practical solutions for complicated transfer pricing issues, and he has published numerous articles based upon his time-tested transfer pricing strategies. He continues to be sought-after transfer pricing speaker for CPA firms and other professional service firm networks.
Hello, everybody. Thanks so much for taking the time to join. Let me get started. There's obviously tax reform's a big issue. For many companies, we're all trying to get a handle on how tax reform affects our clients and also, or perhaps our company itself. What I'm going to do, just to bring everybody up to speed, I'm going to go through a number of transfer pricing fundamentals just to make sure we're all on the same page. We're going to be talking about assessing transfer pricing opportunities and red flags from an audit perspective. But certainly the deeper dive here is identifying tax reform savings through transfer pricing planning. And finally, we'll jump back to, well, how do you defend transfer pricing issues, perhaps if you do push through any of these approaches. Let me give you a high-level example as to why transfer pricing is important. And this is a very common structure. We've got a German manufacturer parent selling auto parts to a U.S. distribution subsidiary. Which then on-sells to U.S. retailers. Now, what's important here is that the transfer price of those auto parts drives how much tax you pay in Germany versus how much tax you pay in the U.S. So effectively, you've got two tax authorities looking at the same transaction. If the German parent company charges too much for those auto parts, the IRS is unhappy. If the German company charges too low a price, the German tax authority is unhappy. And of course, it also drives how much tax you're paying. In this case, Germany, 30%. I'm going to talk about 35% because that's all open tax years, but that's obviously going down to 21% for many companies as of 2018. Now we're talking goods here, but it really doesn't matter if it's goods, royalties, service charges, loans. If the transaction crosses borders, there's a transfer pricing issue in play. just to be clear, this involves one company that operates on a cross-border basis. So it's in this case, a German parent US subsidiary. They have to be related for transfer pricing rules to come into play. All right, so let me take a little deeper dive. Let me give you an example of Starbucks. This is one of my favorite examples, but let's say we've got Starbucks buying coffee beans on exchanges in Switzerland. They send them to Starbucks in the Netherlands, which roasts the coffee, which then on-sells coffee beans to Starbucks in the UK to retail outlets. Starbucks in the UK also pays a royalty back to the US for the brand name, running of the business, what have you. Now, here's the question that comes into play on transfer pricing. Where should profits be generated? Kind of a trick question, because I do know, maybe I don't know exactly how much profits each company should earn. I do know one country that did not get their fair share of profits, and that was the UK. The reason being is that Starbucks only paid tax once out of the previous 11 years. So activists took over Starbucks outlets in the UK and turned them into homeless shelters for the day. And I really can't think of another tax issue that drives quite a bunch of passions. And the Starbucks managing directors were also called in before Parliament to ask why they weren't paying their fair share of tax. Why? Well, other coffee shops that were operating in the UK were paying tax, so why wasn't Starbucks? Now, Starbucks said that it was really the high London rents and some mistakes made there that drove the losses, but everybody else said, maybe it's the price of the coffee beans coming to the UK or the royalties that are being paid back to the US. So contentious issue, and because everyone wants their multinational companies to pay their fair share of taxes. Okay, so with that really, the whole idea behind transfer pricing is to make sure that companies pay their fair share tax globally. And that's based on the arm's length standard. So in other words, I should pay for coffee beans or royalty rates or what have you as if we were unrelated companies. Now that sounds great as a principle, a little more difficult to put into practice. Fortunately, the transfer pricing principles are similar globally. So everything we're talking about, except maybe tax reform, that we're talking about from a transfer pricing perspective applies on a global basis as well. So really kind of begs the question, all right, we have this arm's length standard. How do we prove that transfer prices are correct? And what happens if a tax auditor disagrees? So those are kind of the compliance issues, but the question we're also going to address here is, hey, how can you optimize transfer pricing while managing risk? Certainly a balancing act, but with tax reform, we've got a lot of changes in play here. All right, so where's transfer pricing an issue? I think we've made it clear. Conceptually, it's a pretty straightforward issue. Every company with cross-border transactions has a transfer pricing issue. So if you're an international company with US subsidiaries, you've got a transfer pricing issue. If you're a US company with international operations, you have a transfer pricing issue. Again, goods, royalties, services, loans, any kind of transaction that plays, there's a transfer pricing issue. Question is, hey, are there some straightforward strategies that we can put in place or talk about to get a handle on what transfer pricing issues might be, and again, what kind of opportunities or tax savings that may be out there. All right, so now you may say, hey, aren't most companies managing their transfer pricing to minimize their amount of tax? Yes, some are, but actually I find a lot of companies don't necessarily have a good handle on this, and there's a couple of reasons for that. Quite often what you'll find is, let's take an example. We've got a US company, a pharmaceutical company that has come up with a cure for the common cold. And they've charged a French subsidiary that manufactures their product. They charge for ingredients, and they also charge for royalties or the intellectual property. And quite often what you'll find is that you'll ask, well, how did you come up with your transfer prices? And quite often you'll hear, well, we have a cost plus 10 policy. And maybe that's the right answer for companies. That being said, quite often you'll find that transfer price policies come up from, were decided 10 years ago when the business has changed substantially. Maybe that cost plus policy leaves most of the profits in France. Well, IRS problem. Or maybe that cost plus 10 policy leaves little to no profit in France. Well, then we've got a French tax authority basis. But from an operational point of view, a lot of companies look at their total profit, and from an operational point of view, that's certainly the right answer. They're trying to minimize the cost of making something and sell it for the maximum profit possible. And that makes a lot of sense. And they say, well, we don't really care where the profits end up. Well, tax authorities do care. So while a company may be running it as in a global organization, this transfer pricing issue drives how much tax is paid. And so a lot of times, companies aren't necessarily trying to shift profits from one place to another. They're managing it from a global 30,000 foot basis without thinking about which tax authority is going to be happy or unhappy. And a third, which actually may be a little surprising, let's say, for example, the US company plant manager actually earns a higher bonus if they charge their sister companies more. So a lot of times transfer pricing can be a diplomatic issue because someone's bonus is driven by how much they charge everybody. So what would happen there? Hey, if I'm a US plant manager and my bonus is driven by how much revenue I have, if I charge my sister company or subsidiary more, I get a bigger bonus, but I've also created a tax exposure in the other country. Why? Because they're not paying their fair share of tax overseas. So yeah, believe it or not, I'm not trying to be an apologist for big companies or small companies that are expanding internationally, but quite often there's a couple of different issues that come into play, regardless, beyond just how much tax I'm paying and how much cash I'm generating by country. All right, now let me just run over a quick example of how expensive or how an IRS audits transfer pricing. So let's say, for example, the IRS says, hey, we don't think your cost plus 10 policy leaves most of the profits over in France. We're going to issue a transfer pricing tax adjustment, in this case of $10 million. So what happens there? Hey, we're paying additional tax of 35% of 10 million, so 3.5 million. But you also pay non-deductible penalties on top of that. And those penalties go up to 40% once you exceed 20 million. Why is this so just from a 30,000 foot view, what's happening here? Well, this gets to be a very expensive issue very quickly. Why? We're not arguing over depreciation or meals and entertainment expenses. we just don't think you're paying your fair share of tax, and therefore we want $10 million worth of taxable income. So with that being said, I've put 35% here because most tax authorities, most open tax years at this point are still at the 35% rate. So again, this case, $4.2 million plus interest, because this takes a while to settle, plus US state taxes, plus does the country on the other side automatically agree that they should get a refund in the other country? Well, actually, no. And you have to go through a long process to get there. So long story short, you've also got a double tax issue. So again, real expensive, but we're going to talk through some strategies to identify these types of issues and how can you mitigate these risks, plus identify opportunities. Now, is this a real life example? Well, look, Coca-Cola is another company that's facing some transfer pricing problems. The IRS and Coca-Cola right now are litigating a $3.3 billion transfer pricing case. Basically, and what's come down to is that the IRS is saying, well, great that Coca-Cola has a lot of subsidiaries internationally, but based on our calculations, the IRS says that the foreign licensees are earning over $11 billion in profit, while the US is only earning $800 million. And from the IRS's perspective, they're saying, well, Coca-Cola has come up with the brand, the formulas for products, and therefore most of the profits should be in the US. The IRS is saying, the company is saying, well, there's a lot of investment and time and effort in breaking into new markets, and therefore more of the profit should be in foreign subsidiaries. Now, so what's the thought process here? Well, one thing you'll find that in general is that the IRS, for US-based companies, is that foreign subsidiaries should not earn an excessive return. And just to be clear, the IRS is more focused on results rather than transfer pricing policies. So why? Well, bottom line results drive how much tax you pay in each country. So while a transfer pricing policy is very helpful and a best practice, the IRS's starting point is going to be what are the results at the end of the day. One other observation, the years covered of 2007 through 2009, it's not a misprint. They've been arguing over this transfer pricing case for a good 10 years. And my understanding is that Coca-Cola is still relying on their old transfer pricing policy. So you can expect that however things work out on this 2007 to 2009 case will also be applied to all the years up to now. All right. So what if you're in a situation that the IRS is quite happy with your transfer pricing? Well, that's great if you've got it. That's great if there's that you don't have an IRS problem. But what if you've overpaid tax in the US? So a lot of times I come across some reports or analyses or what have you, and the overseas company is actually not paying much of tax or incurring losses. Well, that's going to cause heartburn from a foreign tax authority point of view. And a lot of times I'll see reports that say, well, the US is earning more profit than they probably should, so everything's okay. Well, since transfer pricing rules apply to both sides of the border, you could have a situation where you're causing heartburn or actually writing the transfer pricing audit adjustment on the Canadian or UK or Chinese side of the border. So one best practice here, you want to be able to explain your transfer pricing on both sides of the border. And that's important, especially when we're coming to tax reform opportunities. So what's the big deal here? Well, a lot of the transfer pricing news stories have led to greater scrutiny for all companies. And believe it or not, over 100 countries now enforce transfer pricing rules. And they also have much higher expectations when it comes to preparing transfer pricing documentation and explaining their results. What I found certainly over the last 20 years is that as more countries have come on board in figuring out that transfer pricing is a great revenue raiser, companies, certainly more companies in the middle market have been targeted than before. When I started out, it was certainly the very largest billion-dollar-plus companies that were being audited for transfer pricing. But if you're operating in many different countries, well, a big a mid-sized U.S. company might actually be seen as a very large company, depending on the location you're looking at. The other thing that's I find interesting is that, well, yes, more companies are facing transfer pricing audits, but I find a lot of companies, if they can take some practical strategies to figure out how transfer pricing should be, well, they're also be more likely to see some tax benefits from transfer pricing planning. All right, well, I haven't seen too many questions yet, so I'm hoping everything's clear from your perspective. So is there more to transfer pricing than audit compliance? Well, actually, yes. U.S. tax reform, as we'll talk about, with lower tax rates, drives how much has changed the incentives for where companies are, how companies are managing their transfer pricing. And I'd also emphasize that if you have companies with tax losses in any particular area, location, that there actually may be some real big savings from addressing those tax losses. Now, there are certainly some compliance side issues to be aware of. Right now, the IRS has a relatively recent audit campaign for foreign-owned distribution companies. In fact, it's really the first time I've seen the IRS go after middle market companies. Their thought process is that foreign-owned U.S. distribution companies should not be incurring losses or generating minimal profits. Now, and sometimes you'll find a lot of companies have to disclose transfer pricing as an uncertain tax position because, again, two tax authorities can audit the exact same transaction. And that also comes up in M&A and due diligence questions. Let's go a little bit deeper on tax savings opportunities. So here's what I would suggest reviewing as part of trying to get a handle on transfer pricing. Best practices, you want to understand where a company is generating their profit. So what I would strongly suggest is looking at country by country income statements over the past 3 years. So that's an income statement that's segmented between, let's say, the US, France, Canada, China, Mexico, what have you. So that'll give you a good handle on how big is the company in each country, and where should you focus on your time. Second thing is to look at the most recent U.S. tax reform return, and I'd focus on Form 5471, 5472, as I listed on the screen. And the reason that's important is that you can get a handle on how big are the transactions or what's the volume. You want to focus your time on those countries, on those transactions that are largest. Third thing to ask is for U.S. transfer pricing documentation or foreign transfer pricing documentation. Why? Well, that actually may give you a handle on how the company operates on a global basis. And even the old ones might be useful as well, and perhaps for also for no other reason than it's a good way to understand how the company operates, or perhaps better, how they see themselves as a global enterprise. And again, practical approach, where profits ending up within the organization, where are the largest transactions, and hey, does it make sense in terms of how you explain the transfer pricing? All right, so let me talk you through what may be a surprisingly straightforward way to realize some savings on transfer pricing. Let's say we'll take a German parent company with a US company subsidiary that's reselling, kind of like the first example we were talking about. Company that has about $70 million in US revenue. They buy in euros. There's a very long sales cycle. So in this case, we've got a situation where the company's facing a market downturn. The US company is earning minimal profits or losses over the past 3 years. And I'm going to assume in this situation that the German parent company has $6 million worth of profit at a 30% rate. What's important here? Well, let's think about it from a practical perspective. Does it really make sense from an arm's length point of view? Does it really make sense that a US an independent company, would they continue buying products from an independent company and incurring losses year after year, or minimal profits? Well, probably not. So does this pass the smell test? Well, maybe, maybe not. There could be some very good reasons for it, but most tax authorities are going to have heartburn over subsidiary companies incurring a loss or generating minimal profits. So the other thing is to focus on is earnings before interest and tax, and these are book numbers. And again, I recommend that because many transfer pricing studies focused on EBIT as a percentage of sales, and it's also a relatively straightforward number to calculate at the end of the day. All right, how can we utilize the tax losses and reduce audit risk? Well, from an audit risk perspective, even middle markets companies are caught up in this, that they have an audit campaign for foreign-owned distributors. They don't like the fact that a subsidiary, which has relatively little control in most cases on transfer prices, and it's a relatively straightforward transfer pricing adjustment. Now, could there be reasons for this? Absolutely. Perhaps the subsidiary company's warehouse burned down, and that was an extraordinary expense. But you want to get your arguments together on that before an auditor knocks on the door. The other thing is, hey, wait a minute. What if the German parent company reduced the transfer pricing to utilize, or just to bring it up to zero? Well, in that case, the German parent company income would fall from $6 million to $3.5 million. So that right off the bat generates, in this case, $750,000 in tax cash savings. Meanwhile, you're also reducing the IRS audit risk at the same time. So kind of a twofer at the end of the day. Good question that just came through. What would the German tax auditor say? Well, they may have some problems or concerns about adjusting the transfer pricing, but if the shoe was on the other foot, the German tax authority would be unhappy about a German subsidiary incurring losses. And I would strongly suggest pointing to the US company and saying, they're incurring losses, that doesn't pass the smell test on both sides of the border. So again, great tax savings opportunity by utilizing losses by changing your transfer price. Another good question, are you allowed to change transfer prices during the year? Well, question I guess respond with that most often is that, do you change your prices during the year? And most companies do. So really, as just part of normal business practices, if transfer pricings aren't right, yes, you can make the change. It's helpful to have an intercompany contract to facilitate that. And so maybe as a talking point or a thought to consider, as we're coming up with the end of 2019, this might be a great time to figure out, if you do have companies or subsidiaries with losses, that maybe it's a good time to adjust transfer pricing. Finally, last observation here, we're talking about US losses, but you can bet that in all the 100+ countries around the world that enforce transfer pricing rules, they're all going to have heartburns over subsidiary companies incurring a loss. All right, so what's a transfer pricing best practice? Look, review the annual profit margin of each subsidiary. That's a great place to start. If the subsidiary is incurring losses or has large tax NOLs or net operating losses, there's a subsidiary tax risk. If there are large profits in the subsidiary, well, that's some parent tax risk. And also focus on all open tax years. So that last thing, the tax savings opportunity is, it's really an opportunity. Changing the transfer prices can really generate some real cash savings. All right, so let's dig into tax reform strategies, because I think there's a lot of people interested in that. Sure. Now, let's think about the Tax Cuts and Jobs Act as a whole or a policy point of view. The Tax Cuts and Jobs Act changes incentives for multinationals. So, for example, for C corporations, we've got the tax rate reduced to 21%. Why? Well, the strategy or the policy in place here is to create more incentives for US companies to invest, and certainly foreign companies to invest in the US. So we don't have one of the highest rates for developed countries of 35%. That's cut substantially. One thing that's overlooked, though, is that some export income may be taxed at a 13%. That's called the Foreign Derived Intangible Income, FDII. The other thing that's come into play is that the IRS and Treasury wants to make sure that holding intellectual property offshore is less beneficial. In other words, they want to discourage it, and that's part of the GILTI tax that's come into play. All right, so what does that play? How does that come out? Well, again, from a multinational perspective, and also for just US companies, tax reform is designed to incentivize US investments in the value chain. So do more in the US, increase employment, increase wages, and also incentivize US exports through lower tax rates. Now, where does transfer pricing come into play here? Well, increases to transfer prices may actually improve the global effective tax rate. Why? Well, if you can increase your taxable income in one country at a lower tax rate while increasing deductions overseas, you have a better tax answer. All that being said, this has got to be justifiable. There's got to be a factual basis for doing these types of changes. All right, so let's put some numbers behind that. Well, again, let's say we've got a situation where we've got a US company that is licensing software to a foreign subsidiary. And in this case, US taxes are 21% of the $10 million, or $2,000,001. On the foreign side, we've got taxes are payable at a 30% rate on $5 million in taxable income. Okay, this is a pretty standard foreign parent US subsidiary type situation. In this case, it's an IT issue, or IT company, but same rules or same thought process applies whether it's good prices or service charges. This all has the same type of impact. Appreciate this slide is a little busy, but bear with me for a moment. If we're going to talk, in the left side, we've got the US company parent and a foreign company subsidiary where the royalty charge is $2 million. Right now, the taxable income, like we said before, is $10 million, and the foreign subsidiary's income is $5 million, just like we were talking about before. In this case, we've got taxes payable of $3.6 million. All right, relatively straightforward calculation. But if the royalty charge can be increased from $2 million to $3 million, again, if facts justify it, well, we've got more taxable income at 21%, and we've got less income taxable at 30%. So in this situation, the savings is the tax rate differential between the US and the foreign subsidiary tax rate. Now you may say to me, well, how do you justify that type of thing? Well, hold on. In the last 30 years until tax reform, most companies, if anything, if they were doing tax planning, they wanted to make sure that they were minimizing their tax footprint at the end of the day in the US. They didn't want to pay 35% rates. Well, again, tax reforms changed the incentives in that there's a lower rate in the US by comparison to many trading partners. Realistically, most companies have tried to minimize their tax footprint over the years. So in other words, they've been trying to minimize the taxable income in the US. From my perspective, I find generally there's room to move here. Again, because if anything, they were erring on the side of having less profit in the US and more overseas. So that's kind of a compelling tax savings that, again, may not be readily obvious at first glance. All right, let's take this a little deeper. You may have heard about the foreign derived intangible income. It's part of tax reform. Most people have been focused on the GILTI tax, but here's actually an export savings opportunity that, again, may be overlooked and may be a great opportunity for a lot of companies. But effectively, and certainly most companies and tax advisors or accountants, we're all trying to get our handle on how to calculate this foreign derived intangible income. But, a lot of the regulations really weren't published until early this year. So it's certainly understandable that we're all trying to figure out how to calculate, much less do some planning. But here's the thought process from a, again, practical high-level view. Tax reform emphasizes that you want to do more high value added activities in the US. Why? Well, they want more high value added activities done in the US. So effectively, you've got a tax export incentive to where once you get over a certain threshold, you're paying tax at 13% rather than 21%. So if you can increase transfer prices, again, justifiably, if the facts allow, you can increase foreign derived intangible income, Now this slide gets a little busier, but it's the exact same numbers. In this situation, we've got the US company with $10 million in total income again, but $8 million is profit from domestic income, and $2 million of it is foreign derived intangible income, or profits from serving other markets. Now, there are some important rules here, but suffice it to say, US companies that are serving other markets or charging royalties or services, once you get over a threshold of 10% of qualified business assets, that rate is 13%. So in this situation, if we do the exact same increase in royalties, you actually have a situation where it's more income at 13.125 or and less taxes at 30%. So an even bigger tax saving. So again, while we're all trying to get a handle on how to do these calculations, there's actually some incentives here that are really helpful that you can run with. And again, in this case, on C corporations. All right. So what lessons can we draw from here? Well, we've got a lot of companies that are doing investments in artificial intelligence and new plants and more activities in the US. So there's probably some good reasons for many companies to consider increasing their transfer prices. Excuse me, jumped ahead. So let's say we've got a new R&D plant. Well, if our new R&D activities are generating more intangible income, maybe we should be charging our subsidiaries more. Same thing from a US plant. Well, hey, if we've got a new plant that runs rather well and we're generating more income from those exports, hey, maybe we should be charging higher goods prices for that, for those subsidiaries as well. But the tax benefit at the end of the day is there's additional US tax and greater deductions. Excuse me for the slide problems here. All right, so that's perhaps more the policy that could be helpful in terms of savings. You've got to have evidence of foreign use, and that's what part of the regulations that have come in to play here. And there's got to be, again, substance behind these transfer pricing changes. Now, but don't think these things are happening in a vacuum. Foreign companies or foreign tax authorities know about these new incentives, and they are on the lookout for companies that are changing the transfer prices. There is a risk-reward situation here. So yes, there are higher risk of foreign audits if you increase transfer prices, but if it's justifiable and you can explain your case, you're going to be in a lot better situation than most. What about on the inbound side? Well, maybe we don't have the 13% rate, but for a lot of companies, it may make sense to lower transfer prices for goods, services, royalties. Again, it's got to have some substance behind it, but you'll have more income or less deductions, more income in the US and less income overseas. And again, why? Well, we've got a lower rate in the US. One side benefit possibly could be you also may be paying lower duty rates. Unfortunately, customs valuation rules and transfer pricing tax valuations rules are different. That being said, that may be a additional bottom line tax savings from taking a fresh look, given all the duty rates that are coming to play. Let's talk about defending transfer pricing. And this is really key because, again, if we're thinking about doing increases to transfer pricing or reducing transfer pricing, it's important to have your story straight because, hey, there may be some tax authorities interested in the thought process here. Now, what are typical deliverables? Certainly, this is, we have perhaps the highest level is the transfer pricing documentation. A lot of times this is called the penalty protection issues or penalty protection document, but effectively it's an explanation of what's happened in prior years, involves some detailed interviews to understand how the business operates from the US side and the foreign side. And it is some higher, perhaps it's more for some of the larger companies, but effectively it's a document to ideally prevent a transfer pricing adjustment at all. But certainly from a US perspective, if it's, we'll talk about how it applies to penalty protection. Second, what I find is for a lot of middle market companies or companies that are just trying to get a handle on transfer pricing the first time is what's called the transfer pricing benchmarking study. And that's determining a reasonable amount of profit for each subsidiary. And the company adjusts their transfer pricing to reach a target profit margin. You also may want to look at transfer pricing when it comes to restructuring, supply chain management or changes, new business lines. And also I see a lot of companies that are trying to figure out how to charge out for back office services, IT, HR, admin, strategy situations, because again, that affects what profits are on a global basis too. Practical observations. Well, the IRS normally requests reports with a 30-day deadline. It's not too late if the deadline's missed, but you're going to have to hurry. And given that you have to do so many interviews, you have to do interviews and have your factual story straight, it's really important to, ideally, you want to have the report prepared by the time you filed your US tax return. But the goal is here, you want to make sure that if there's no transfer pricing adjustment, there's no additional tax due. And most transfer pricing studies cover a 3-year period, if not more. So even if we've got a situation where it's a 2016 audit, perhaps some tax authorities will accept a 2016 to 2018 study. The other thing is also, and the other thing is, it's very important to have intercompany legal agreements, especially to make sure you can explain where intellectual property is owned within the organization. I'm speaking, and again, the 30-day deadline, good question here. The IRS assumes that you've been notified by the IRS for a transfer pricing audit. Yes. The other thing is, you do not file these reports with the tax return. They're actually supposed to be requested under audit. All right, so what does transfer pricing documentation include? An analysis of how the business operates in the US and overseas, an industry analysis, an explanation of how the business operates. But at the end of the day, you want to explain to a tax auditor how the business operates and why the transfer pricing is correct. And it's really your first and best opportunity to avoid an audit. These are the types of questions that are asked in this situation, R&D. One of the reasons I really enjoy doing this is you get to meet very interesting people, and asking why their product or service is better than someone else's is a really fascinating story. Transfer pricing documentation doesn't mean you're guaranteed that the IRS will agree with you or another tax authority, but it does remove the penalties if you prepare it by the time the tax return is due. If you're new to this, I wouldn't worry about the methods at this point. If you've got a handle on where profits are ending up in the organization, you're going to be far better off than most. This is what a benchmarking study is. Try to get a handle on what profits should be for a subsidiary based on publicly available information. And so here's my summary, and I know I'm just coming up on the hour mark here. Look, transfer pricing rules certainly apply to all multinationals. Using off-the-shelf, readily available information is a great way to get a handle on where transfer pricing risks are and where might be there some opportunities. Utilizing tax losses is a great way to save money. And now with tax reform, we've got savings through lower US tax rates. Finally, if you're going to do this, you want to make sure that you're documenting your transfer pricing changes on a current basis. Last question I'm coming across, do transfer pricing methods differ if it's a brother-sister company? No. So transfer pricing rules apply whether it's parent subsidiary, brother-sister companies, doesn't matter. You need to comply with the arm's length principle.